investor friends, I'm Michelle Marki, and sometimes people like my friends and family ask me what are the best stock funds to invest in their 401ks or Roth IRAs. And if you've seen some of my recent videos, you know that one of my favorite investors is Warren Buffett, one of the best investors of all time. And he said that 99% of people should invest in a low-cost index fund. And he's mainly talking about the S&P 500, an index of the 500 largest companies in America. And so based on this, I'll share my 3 criteria of what I look for if I were to invest in an S&P 500 index fund. And they include low expense ratios, 0 minimums to invest, and 3 performance rates. And so I've gathered 4 index funds that are mutual funds and 4 exchange traded funds or ETFs to share with you that are covering the S&P 500. And you can also look at different brokerage offerings to see which kind of brokerage account you might like to have, because this is mainly based on your own personal feeling and user experience of each brokerage. So depending on what you already have or might want to open, these can influence your potential decision in which S&P 500 fund to invest in. And so if that sounds good to you, please be sure to like and subscribe, and let's get into these funds. And please allow me to reassure you that none of this content is sponsored. It's just for your education, information, and entertainment purposes, where I'm trying to give you the information that I would like to know if I were in your shoes and considering investing in an S&P 500 index fund. So I'm not going to favor any particular brokerage, but based on the quantifiable data, you can make your own decisions on what makes sense for you and the brokerage account of your choice. And the 3 main brokerage accounts that I'm going to cover that I think are pretty reputable and that a lot of people use include Fidelity, Vanguard, and Schwab. And of course, you could likely buy some of these index funds and ETFs in other brokerage providers, but I didn't try to look at investing through those other brokerages. So just check those out if you want to compare and contrast what the final expense ratios and minimums to invest might end up being. But what you also don't want to do is invest in, say, a Vanguard S&P 500 index fund in a Fidelity brokerage, because then you're going to pay what's called load fees, and that can cost you $75 per transaction. So you don't want to do that. If you're going to have a Fidelity brokerage account, just invest in Fidelity's S&P 500 index funds or ETFs, because they have them too. And so that's what I suggest being on the lookout for as well. And hopefully you can't go too wrong if you're investing in any one of these S&P 500 index funds, because they do a pretty good job of tracking the S&P 500 index. So overall, their performance is pretty close, and I'll take you through what I specifically look for in each of them. And if you're wondering what is a good low expense ratio, in my opinion, it's anything below 0.2% or about $20 per $10,000 invested. And for your reference, in 2021, the average stock index mutual fund charged 0.06%, which works out to $6 per 10K invested. And the average ETF charged 0.16%, which works out to $16 per 10K invested. So all of those are pretty acceptable. What you want to avoid is investing in any mutual funds or ETFs that charge above 0.5% or over $50 per 10K invested, unless you really trust the manager of those funds, because you could be losing out on a lot of money that you could be earning based on your principal compounding. So you want to go for the lowest expense ratios possible if you're not preferential to any particular fund. And luckily, most index funds have pretty low expense ratios. So we've lucked out, because a couple of decades ago, a lot of mutual funds used to charge between 1% to 2%, which is about $100 to $200 per 10K invested, which is a lot of money. And it could mean the difference of having a few $100,000 less during retirement and ending up with below $1 million. So as much as possible, you want to avoid high expense ratios. So one particular example that I'm just going to bring up that does a pretty good job of offering a very low expense ratio is Fidelity's 500 index fund with ticker symbol FXAIX. And as we can see, their expense ratio is only 0.015%, which means it's $1.50 per $10,000 invested, which you can think of as the equivalent of Costco's hot dog and soda combo. So you're basically paying that same amount for investing $10,000 in FXAIX. And as we can also see, they have zero minimums to invest. And that's pretty good because like 10, 15 years ago, there used to be minimums with some of Fidelity's basic index funds to invest in. So they've also brought down the commissions and the minimums to invest in. So that's pretty good. And their performance tracks pretty well to the S&P 500, where I look at the 5-year and 10-year performances the most, where it was for 5 years, 9.23%, and for 10 years, 11.69%. And compared to the S&P 500's respective 9.24%, and then for the 10 years, it was 11.7%. All of that is pretty good. So overall, this Fidelity Index Fund is a pretty good example of a low-cost S&P 500 index fund. And the 4 index funds and 4 ETFs that I'm about to show you all do a pretty good job of tracking the S&P 500's performance, with the exception of one that's a little bit different but has the lowest barriers to entry. So I thought it was worth considering. Include the 4 index funds of Fidelity's FXAIX and Schwab's SWPPX, Vanguard's VFIAX, and Fidelity's FNILX. And the 4 ETFs include Vanguard's VOO, iShares IVV, SPDR's SPY, and SPDR's SPLG. And I look at the 5-year and 10-year performance averages, and overall the average is 9.22% over 5 years, and 10 years is 11.66%. And if these funds track that pretty well, it's pretty good, where the best 5-year performance was by SPLG at 9.28%, and the best 10-year performance was FXAIX at 11.69%. But all of these, with the exception of FNILX, are pretty close to the averages, so you can't go too wrong, with the exception of maybe SPY. That one has the lowest averages of 9.16% over 5 years and 11.6% over 10 years. So maybe that one is the least good, but overall they're all pretty decent, so you can't go too wrong. And then looking at the expense ratios and the minimums to invest, if we look at some of these, they're all pretty decent, where they have an overall average expense ratio of 0.03%, and that works out on average to about $3.19 per $10,000 invested. And the one that I mentioned that has the lowest barriers to entry is FNILX with 0% expense ratio, which is fantastic for anyone who doesn't want to pay any fees to be invested in an index fund. And if we compare this down the list, SPY has the highest expense ratio of 0.09%, which means it's going to cost you $9 per 10K invested, or the equivalent of 6 combos of hot dogs and sodas from Costco. So keep that in mind if it makes a difference to you. And also, as far as the minimums to invest, most of the index funds are pretty good with 0 minimums to invest, except for Vanguard VFIAX, which has a $3,000 minimum to invest in that fund. So for that reason, and for the fact that its expense ratio is a little bit higher than, say, Fidelity's and Schwab's, makes it a little bit less attractive than those first two. And then also, if we think about ETFs, for Vanguard's VOO, you have to buy at least 1 ETF share in order to invest. But maybe, depending on the brokerage you use, if you were to invest in some of the other index ETFs down here, like IVV, SPY, or SPLG, maybe you could buy a fractional share in a different brokerage. So maybe you're not obligated to buy 1 full share, depending on some of the brokerage providers that you can look into, which allow you to invest only in fractional shares. But basically, for 3 out of 4 of these index funds, there are 0 minimums to invest. So conceivably, you could even invest as low as 1 penny in some of these index funds. And then for the ETFs, you might actually have to buy 1 share if your brokerage doesn't offer fractional shares. And if you're wondering what's the big deal between investing in ETFs or mutual funds in terms of some of the extra fees that might be included, apparently, usually ETFs have lower expense ratios, but they might incur some transaction costs when you're purchasing or selling them compared to the mutual index funds that don't have those same transaction fees. So that might be a little bit of a difference as far as what your final cost might actually end up being if you were to own ETFs compared to the mutual index funds here. And then also when it comes to the FNILX, even though that is pretty close to the S&P 500, it's slightly different because it's based on Fidelity's US large cap index fund, but that's actually pretty close to the overall S&P 500, where the FNILX has 514 holdings, whereas FXAIX has 506 holdings. So it has a little bit more stock holdings in FNILX, and also it actually has a worse performance for the year, where it's down about 17% compared to the S&P 500 being down about 15.5%, but maybe that's a buying opportunity if it might be more on sale compared to the S&P 500. Who knows? But that might be another factor to consider if you were to invest in FNILX. And you may be wondering about alternative funds that have comparable performance levels to the S&P 500, which is heavily weighted toward the largest cap companies in that index. And so an alternative might be Invesco's S&P 500 equal weight ETF with ticker symbol RSP. And what it aims to do is be equally invested in the 500-ish companies in this ETF and not more predisposed to the largest cap companies. But the expense ratio is higher at 0.2%, and its overall performance averages are trailing the S&P 500 index and ETF funds that I've told you about before. So overall, I don't think it's necessarily worth it. And then another alternative might be Fidelity's Total Market Index Fund with ticker FSKAX, and this one has holdings of 4,000 equities, which is kind of a lot. That's 8 times as diversified as the S&P 500. So for all that, even though it has a low expense ratio of only 0.015%, is also trailing in its performance compared to the other S&P 500 funds. So overall, between the both of these, I wouldn't go with them because they're just not delivering as high of performance as your standard S&P 500 index funds or ETFs. And the final thought I'd like to share with you is you may be wondering if there's a good time to invest in the stock market, and the answer is going to be highly subjective. But one pattern that you might want to consider looking at is Buffett's yardstick comparing the overall US stock market's value to US GDP. So it takes the Wilshire 5000 of stocks and compares it to America's gross domestic product. And based on this yardstick measure, it seems that the stock market is still valued at 151% of GDP. And historically, Buffett considered the market to be fully priced between 100 to 120% and more on sale when it was below 80%. So if you go by that, the stock market is still pretty highly priced, but year to date, the S&P 500 has come down a lot from its all-time high of 4,800, and it's down by about a quarter. And so maybe a 25% discount to the S&P 500's all-time high is good enough for you, and maybe you can think of it as buying good quality businesses at a discount, just like when you're excited to buy something on sale at the grocery store. So if you think about it like that, maybe you're already getting about a quarter off the highest price, and if you keep dollar cost averaging down, maybe you can get in at a pretty good overall amount that, even though it looks like your portfolio is going down at the time, eventually you have faith that it will recover and that these stocks will do well again in the future, and the American companies that they represent will also do well when they recover from any economic ailments currently impairing their market value. So hopefully everything will turn out for the best, because that's what you're hoping for when you ultimately invest in an S&P 500 index fund. And so if you enjoyed this video or learned something, please like and subscribe. And I wish you well on your journey to being the best investor you can be. Till next time.